Hello, and thank you for taking the time to listen to this short update. We've been receiving lots of questions from investors asking us about current market conditions in today's private credit market. Their concern is absolutely understandable. There have been lots of headlines, and we all know that headlines can amplify fear, particularly when they focus on pressure points without the broader context. And the media likes to focus on the pressure points and often ignore the context. So in this short piece, I'd like to step back from the noise and look at the facts. Whilst what we are seeing today is understandably worrying, we need to avoid talking ourselves into thinking that this is a crisis. My working career, which started somewhere around 1978, has spanned close to 4 decades. And for some of our Zagga colleagues on our subcommittees, they have been working much longer than that. We have seen every financial crisis since then. What we are seeing right now can't be defined as a crisis. A crisis is normally associated with systemic risk, with widespread distress, and an absence of liquidity. These are not what we are seeing now. In Australia today, banks remain well capitalized and are very active. In fact, they're still 83% of the lending market for property. Although property conditions are much softer, we're still seeing transaction activity and liquidity through the market. Unemployment remains relatively contained, and the broader economy is showing some signs of growth despite inflationary and cost of living pressures. The RBA snapshot points to a more challenging environment, but we know that the governor recently held the cash rate steady, recognizing that many of these factors are in fact external factors which are pushing inflation rather than internal factors. So, in my view, and it's my view, there may be others who differ with me, the right way to characterize today's conditions is not as a crisis, but as a correction. The kinds of pressures we are experiencing now are the kinds of pressure that markets work through over time. In order to navigate these challenges, it requires discipline, selectivity, and active management. For us at Zagga, writing new investments is about backing the right asset with the right developer in the right market at the right price. I often say that we ride the jockey first and then the horse. Our focus remains on assessing each and every opportunity on its own merits. There is no cookie cutter approach. We look at each loan, each sponsor, and each asset according to their own individual merits. Each opportunity needs to be assessed within its own specific circumstances. And each loan we write needs to be understood within the context of our ability to repay capital to our investors primarily and then to pay their return. This discipline is important in all markets, but it becomes even more crucial during periods of realignment, such as the one we are in right now. All of that said, we still see tremendous opportunity in the commercial real estate debt market and in the Australian real estate market today. For FY26, which ended on the 30th of June, our originations were up 86% on the previous year. Over the past 90 days, we've received more than $1 billion in new opportunities, but have only written just under 10% of those. This just shows how selective we are being. Disciplined investment managers can play an important role, provided they remain selective and do not compromise their fundamentals. In the 10 years that Zagga has been going, we have always focused on that discipline and on those fundamentals. We believe in the thesis in Australia today. Australia now has a population approaching 28 million people. That population is likely to increase by another 9 million people over the next 25 years. Net migration is still running at around 300,000 people per annum. The housing supply has failed to keep pace with the population growth. This leaves an estimated shortfall, depending on which data you read, of somewhere between 200,000 and 260,000 dwellings in Australia today. That shortfall is likely to increase as the population grows. While immigration is certainly easing from post-COVID peaks, demand continues to outstrip supply, and this is what creates the structural tailwind for the private credit thesis. This is where we see the opportunity. And let's not forget that if you're building new accommodation, new houses, new residences, with that, you need to build all of the other infrastructure and all of the other facilities that are associated with that. I'd like to leave you with the following key message in closing. We are living in challenging times. The market is in a state of flux. An adjustment is taking place, driven by both global and domestic factors. But it's these periods of adjustment, while they are uncomfortable, they also present a real opportunity. Taking advantage of that opportunity comes down to how we navigate the cycle and how we keep our eye on the end goal. For us, that end goal is about capital preservation over yield. It's about playing the long game and relying on the positive effect of compounding interest. Thank you for listening, and as always, thank you for your support.